Welcome back to Morning Markets on Thursday the 16th of December. On screen we can see the key market moves over the last 24 hours. If we look at returns in sterling terms, the key takeaways, in general it was a positive day for equities led by the US. The areas which are more sensitive to rate hikes, such as the technology sector, were the beneficiary after the Fed's decision to hold interest rates. A bit of movement in US Treasury bonds post-announcement, but in the main sovereign bonds were flat on the day. It was a stronger day for sterling relative to the US dollar ahead of the Bank of England's monetary policy decision later today. As suggested in the introduction this week, there is a lot of attention on central banks. Later today we'll hear from the Bank of England's Monetary Policy Committee with their decision on the future path of monetary policy. In the last meeting, the Monetary Policy Committee voted to hold rates, which actually went against the market consensus. Earlier this week, we received positive employment data in the UK in evidence of rise in vacancy rates, suggesting demand for workers is outstripping supply, potentially putting pressure on the need for higher wages. We also have the potential implications of Omicron variant being baked into expectations around growth and inflation levels for the committee to consider in their decision. And we look forward to discussing that decision with you on Morning Markets tomorrow. Yesterday, we had the second and final session of the December meeting of the Federal Reserve Central Bank in the United States. The decision was taken to maintain interest rates at their current range of 0 to 0.25%. This led to a strong performance in those US stocks, as I say, potentially and particularly those more sensitive to rising interest rates. Though they held this time, a much more hawkish tone was taken from the meeting. The Fed officials expecting to raise interest rates 3 times in 2022 and a further 3 in 2023. However, in terms of the levels that takes it to, the market expectation does not suggest at this point that they anticipate the Fed rate will exceed 1.5% over the next 2 years. The Fed also agreed to reduce the pace of bond and asset purchases from the program, part from the market, part of the quantitative easing program, which was turbocharged in response to the pandemic back in 2020. Last month, they agreed to reduce the pace of bond purchases by $15 billion per month, split $10 billion of US Treasuries and $5 billion agency mortgage-backed securities. And from January, those numbers will double. Therefore, they will look to increase the pace at which they reduce from purchases from the market by $30 billion per month, taking the total monthly purchases from $120 billion to $90 billion, a signal that they are moving closer towards their targets, but still offering significant levels of support. Governor Jerome Powell made clear that the US economy is running stronger, it's running close to full employment, and both inflation and growth are running above their target. So did not expect an extended wait between the end of the asset purchase program and the beginning of the interest rate hike cycle. In terms of inflation, the Fed provided an update on their expectations, anticipating inflation of 4.4% in 2021 and moderating to 2.7% in 2022. In terms of economic growth expectations, they did moderate at the margin for 2021, but from 5.9% to 5.5%, given near-term risks of the new variant and ongoing supply chain disruption, but did provide strong expectations of 4% economic growth for 2022, sitting above trend and actually up from that expectation in September of 3.8%. The reaction from markets seems to suggest that there's less appetite to challenge the Fed, taking a degree of reassurance that they remain astute to the evolving employment, growth and inflation dynamics. That's all for today. Thank you very much for watching, and we look forward to bringing you up to date tomorrow here on Morning Markets.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.